Life insurance can feel overwhelming at first, not because it's complicated, but because no one slows down long enough to explain what's actually happening. So let's slow this all the way down and walk through it together. If you're struggling, it's usually not because you're not smart. It's because you're trying to memorize something that was never meant to be memorized. This is a system. Once you understand how the system behaves, everything starts to click. Let's start with the foundation. When someone buys life insurance, what are they really doing? They are transferring financial risk. Let me give you a real example. Imagine a father with 2 kids and a mortgage. If he passes away tomorrow, the family doesn't just lose a person. They lose income. They lose stability. They might lose the house. Life insurance steps in and replaces that financial gap. That's it. At its core, it is income protection in the event of death. Now let's talk about underwriting. This is where people get confused. Underwriting is not the company trying to judge you. It's the company trying to group you. Think of it like this. Imagine a gym. You walk in and they don't know you personally, but they look at your habits, your health, your age, and they place you in a category. Insurance works the same way. If someone is healthy, exercises, and has no major risks, they go into a lower risk group. If someone smokes, has health issues, or risky habits, they go into a higher risk group. And here's the key idea. The company is not predicting your life. It is placing you with people who statistically behave like you. That's what determines your price. Now let's talk about money, because this is where things really start to make sense. When someone pays a premium, they think they're just paying for insurance, but that's not what's happening. Part of that money covers the risk, part of it covers the company's expenses, and part of it becomes profit. But here's the part no one explains. The company doesn't immediately spend that money. It holds it. Let's say 1,000 people each pay $1,000. That's $1 million. The company knows not everyone will die this year, so it holds that money, and it invests it. That's called float. And this is where it gets powerful. While that money is sitting there, the company is earning interest on it. So now they're making money not just from premiums, but from time. Think about your own life. If someone handed you $1 million and said you don't have to give it back for 10 years, what would you do with it? You'd invest it. That's exactly what insurance companies do. Now let's talk about something that confuses a lot of people. Level premiums. You might hear that your payment stays the same for life, but your risk does not stay the same. So how does that work? Let's use a real example. At age 25, your chance of dying is very low. So the true cost of insuring you is low, but the company still charges you a higher fixed premium. Why? Because later in life, your risk increases. So in your early years, you are paying more than your risk. And that extra money builds reserves. Later in life, when your risk is higher, those reserves help cover the gap. So the system balances itself over time. Now let's talk about cash value. This is where people get confused because it sounds like savings. But it's not traditional savings. It's more like a reserve account inside the policy. The company is holding money on your behalf and growing it. Now here's where it gets interesting. Let's say you need money and take a loan from your policy. Most people think they're pulling money out, but they're not. The company is lending them money, while still keeping their reserve intact. So your policy continues growing, even though you now have access to cash. But if you don't repay that loan, it comes out of the death benefit. So if your policy is worth $100,000 and you borrow $20,000, your family receives $80,000. Now let's talk about control. Every policy has 3 people involved: the owner, the insured, and the beneficiary. But only one person is in control: the owner. Let me make this real. A parent buys a policy on their child. The child is the insured, but the parent is the owner. That means the parent can change the beneficiary, cancel the policy, access the money. The child has no control. This is important because it shows how flexible insurance can be. It's not just protection, it's a financial tool. Now let's talk about annuities. This is the opposite side of the system. Life insurance protects against dying too soon. Annuities protect against living too long. Let's say someone retires with $500,000. Their biggest fear isn't dying, it's running out of money. An annuity solves that. They give the insurance company a lump sum, and in return, they receive income for life. So instead of managing their money themselves, they've transferred that risk to the insurer. Now the company is responsible for making sure the money lasts. That's the system. Now let's step back. Everything we talked about connects to 4 ideas: who controls the policy, where the money is, how risk is priced, and when money is paid. If you can answer those 4 questions in any situation, you understand what's happening. So here's what I want you to do. Write this down, and don't rush it. 1. Insurance is risk transfer. 2. The company groups people. It doesn't predict individuals. 3. Premiums cover risk, expenses, and profit. 4. The company holds and invests your money before paying claims. 5. Early payments build reserves for later risk. 6. Cash value is internal capital, not just savings. 7. Loans reduce the final payout if not repaid. 8. The owner controls everything. 9. Annuities turn a lump sum into income. 10. Insurance is built to turn uncertainty into predictability. Now look at that list. If you truly understand those 10 ideas, you don't just know insurance. You understand how the system was built. And once you understand that, you stop feeling lost. You start seeing it clearly. And from that point forward, everything becomes easier. You just got the goods from the goods.